In this recording, we're going to look at capital gains tax, or CGT. CGT can be something of a difficult beast, largely because there are actually quite a lot of rules. There are a lot of exceptions to rules, and the CGT regime's been changed a few times. And so, as with a lot of sort of tax changes, Parliament is intending, through changing that law, to tax capital gains in different ways. However, unlike many other areas of tax, CGT by its nature is dealing with assets that are not as often bought and sold. The transactions don't occur as regularly as other areas of income tax. Now, subsequently, all of the changes that have been made to CGT, and in particular the key ones in 1985 and then again in 1999, are things that students, even in this day and this year, still have to go and learn, largely because it's not unheard of to have clients who have assets that have been purchased before each of those dates, and so you need to know the rules that these long-held capital items are going to be taxed under. So we're going to be looking at a half dozen or so scenarios to do with tax, and some of these can be answered quite simply by simply going and finding a very clear and precise statutory rule. Others of them are going to take a little bit more time to explain. So we're going to start with looking at the purchase and then disposal of a car, a station wagon. Then we're going to look at a property acquired before 1984. Then we're going to look at a yacht, and the yacht in that case being disposed of by a gift to a friend. We're also going to look at a piece of artwork that's been bought and then sold at something of a loss at some stage later. And finally, we're going to go through a more in-depth CGT problem to do with the purchase and disposal of a rental property. And so we'll start with one of the simplest categories of CGT, and that's to do with motor vehicles. And for many of us, that can be the largest asset that we actually would buy and sell. And fortunately, Parliament's just said, look, motor vehicles are just simply exempt from CGT. What it means is that when you purchase them, if you happen to on-sell that for more than what you paid for, which is quite rare, you won't be liable for CGT. It also means that when an individual or another entity disposes of a vehicle for less than what they paid for, it's not going to be liable for CGT either. Now, the second question here involves a house, a residence that's been partially used for business purposes. And as you may recall from when we looked at the home office expenses a few sessions ago, that when a person uses and sets up an area of their residence as a home office, that percentage of the residence will become liable for CGT, and as such that that proportion will stay with the house, and the person who owns that particular residence won't be able to claim the main residence exemption from CGT. In this particular situation, though, this house was purchased prior to the 20th of September 1985, and as such is wholly exempt from CGT in itself. Now, this third question involves the disposing of a yacht. Now, again, it might seem that if you give something away, that the value that you're sort of getting as compensation would be zero. However, in that situation, the Federal Parliament's quite clearly mapped this out, that when you gift something away or do it for an amount which is less than an arm's length value, then the proceeds in relation to capital gains tax are going to be deemed to be the market value. Here, that's $8,000. Now, there's some other rules in play here too, and that's that these type of or class of assets called personal use assets, things like boats, televisions, caravans, things that we use but don't, I guess in their very nature, don't usually appreciate in value. And there's, again, some pretty straightforward rules from that. Basically, if you make a loss when disposing one of these personal use assets, that's just wholly disregarded. However, if you make a gain on a personal use asset, normally it will be disregarded, but only if the amount, the original asset cost was $10,000 or less. And so here, with this particular scenario, if the market value when it was disposed was actually was greater than the $10,000, and it was purchased for more than $10,000, then you will realize something of a gain, and that is liable to CGT. Here, for example, if the original asset was purchased for, say, $12,000 and disposed, the market value on disposal was more than that, then you would be liable for CGT here of $2,000. Now, the next component of this question is looking at artwork, and the CGT regime recognizes this area known as collectibles, and that includes artwork, jewelry, stamps, coins, cards, and so on. And one of the things about collectibles is that in terms of their value, they can be a little bit arbitrary in terms of how a person can buy and sell such things. And so what the Parliament's done, quite sensibly really, is to essentially quarantine those. Look, you are still liable for CGT, and you can still claim when you dispose of these things for a loss. However, the loss that you might make in disposing of a collectible can only be used to offset gains, so capital gains that you would have made that are derived from collectibles themselves. So if I spend $50,000 on footy cards and then find that mysteriously I can't sell them for more than $1,000, I can't use that $49,000 and offset that against a gain I might make, say, on residential property. So conclusion for this component of the question, the car, assuming the yacht, the market value when it was disposed, when it was gifted away, is less than $10,000. The car, the yacht, and the house, the disposal there are just ignored, whereas the artwork loss can be offset, but only against future gains this particular taxpayer may have from their collectibles in future years. For the next part of the question, we have to look into the CGT calculations in a little bit more depth. So here we have a rental property, and it was first purchased in November of 1999. And it's really helpful to remember these key changes in the CGT regime. One occurred in September 1985, and so things prior to that, things that have been acquired prior to that, are not subject to CGT. And there was another change in September of 1999, whereby assets that have been acquired after that point in time can no longer use what we call the indexation method. They can only use the discount method. And for assets that you're trying to work a capital gain out now, if the asset was acquired between those times, in other words, between September 85 and September of 99, the taxpayer can elect to use either the indexation or the discount method, and we'll go through those in more depth. Now, another, I think, quite important point to note, particularly with purchases of land, that the key date in terms of purchase and sale is to do with the contract date. It's not the time at which contract becomes unconditional. It's not the time in which the money is received. It's the date that a contract is entered into. That's the key date when we're looking at CGT and doing calculations. And the other thing to note is that there are different types of capital gains events, and the most common one, the most straightforward one, is this event A1. And this arises in a situation such as this, where there is a purchase of real property and then a disposal. So you've bought something and then you've sold it. The most straightforward situation. And so when answering a question of this nature, you really should spell these things out to the person that you're advising in this situation. So here, for example, we would clearly say this is an A1 CGT event. We would note that it was purchased after September 99. So as a result, the indexation method is not available to us. It's only the discount method. And you should also note at this point that given the taxpayer doesn't live in this is a rental property, the main residence exemption isn't available either. Now, in calculating the capital gain, the disposal of a particular capital item. Under the discount method, it's quite a simple formula. Really, it's the capital gain is equal to the proceeds, in other words, what you get for it, less what we call the cost base. Now, the cost base incorporates more than merely the cost of the item. It also includes all of the costs of installing, including what we call incidentals, such as paying for legal fees, paying for conveyancing. It also incorporates capital expenditure, so the amounts that we've spent on this particular asset, in this case the rental property, that is intended to increase the asset's value. And I think it's important at this stage to also note that this cost base, which we may sort of thinking as being like an early in time outlay, actually also includes the costs of disposing of the asset. So that can obviously occur in recent times, because essentially from the tax officer's perspective, the amount that you've spent on this particular asset, obviously the actual cost of buying in the first place, but the outlays you'd have to make in order to acquire it and to dispose of it, these are all taken into account when we're working out what the real cost of this asset was to the taxpayer. And this cost base also includes the non-capital costs of ownership. And again, there was a change in 1991 allowing taxpayers to do this, to incorporate that into the cost base. And this applies for both the discount and indexation methods. Now, another thing to note is that this cost base also includes repairs. It can actually include repairs that have been made to an asset in order to put it in to the desired functional state at the time that things purchased. And so here with this rental property, the cost base includes the purchase price, the fees, solicitor fees and stamp duty and such like to acquire it, as well as the fees to dispose of the property when it's being sold, and also the initial repairs that we would have at the start. So you might be wondering at this point, well, what happened to the interest component on the mortgage? And there's a pretty straightforward response to this, although it may not always be intuitive. And that's the way CGT is structured is that if something falls under another regime, in the case of interest, where it's deductible elsewhere, it doesn't form part of CGT. In other words, you can't sort of double dip between the two. And so here, arguably with a rental property, the taxpayer is going to be claiming the interest deductions as they go throughout the past decade or so that they've had and have been running and using this particular capital asset. Now here, because this is a discount capital gains transaction, because the asset was acquired after September 99, the calculation's pretty straightforward. You determine what the cost base is. Here it's $116,000. We find what the proceeds are, and it's simply the difference between those. So here we're looking at $34,000. Now, because the assets, again, was purchased in 99, it's been held for at least 12 months, then this taxpayer as an individual receives a 50% discount on that. In other words, only half of that amount will be added to this particular taxpayer's assessable income in the current tax year. In this part of the question, we've got a slightly more complex problem, even though it doesn't seem to have as much information. And the reason it's a bit more complex is that the asset's been acquired in December of 1985. So it's not before that magic cutoff period in September of 85 where an asset is not liable for CGT at all. What happens if an asset has been acquired between September 85 and September of 99, then the taxpayer, and assuming it's been disposed after there, in other words, we're doing a contemporary tax return, then the taxpayer can elect to choose either of the methods. Now, this is something of an artificial problem. What you'll find in practice is that the discount CGT method, as time goes by, will actually become more and more preferable for taxpayers. And the reason for that is that CGT assets are no longer indexed after September of 1999. So what that means is that, assuming that inflation is non-zero or above zero, that the amount the taxpayer would have to be disposing of the capital asset for an indexed asset, one purchased between 85 and 99, is going to have to be really low. And again, it's that situation where owning large capital assets such as real estate, that you're only going to use indexation if the amounts in nominal terms that the assets increased by when you disposed it is very, very small. And again, as time goes by, property in general just increases in value, and so it's less likely that the index method is going to be of use to the taxpayer. However, it's still in the books, it's still valid law, and we need to go through and look at both methods and see how they work. So in this particular problem, we're also looking at capital losses as well. So if a taxpayer in year one has got a net capital loss of $2,000, and in year two the taxpayer is selling two CGT assets. One has been purchased in December of 85, so in other words that falls within the indexation period, or the period where the taxpayer can elect to use the indexation method, and it's been sold for $8,000. Whereas the second asset was acquired in 2002 and has been sold for $3,000. So we're just going to go through and look at that taxpayer's gain. So here, with this first asset, we actually have to go through and calculate using both of the methods to determine whether or not the indexation method or the discount method, we determine which of these is actually preferable for the taxpayer. Now, when looking at the indexation method, there's a couple of things we need to examine. Now, the formula looks sort of structurally similar to what the discount method would be, the simple equation where we're just looking at proceeds less cost base. However, and this really goes back to the heart of why the indexation method was used for that 14-year period, and it's something like this: that if a taxpayer were to purchase an asset and that asset only increased in value in line with inflation, when that taxpayer disposes of it, then really they haven't gained anything at all. The purchasing power of money has diminished over that period of time, and it can be quite a significant length of time as well. And so this idea of indexation was really designed to make it sort of fair, and so that there wouldn't be any real sort of distinction between having and holding things as money as opposed to having capital assets. And so to determine what the sort of the indexed value is, or what it ought to be, what we're really doing is to try and calculate, well, if I'd bought this at at point A and then sold it at point B, what would inflation have actually done to the thing? What's the impact of that? And really any gain or loss that I'm going to have is really should be taken into account relative to what this thing, how this thing would have increased in value anyway with inflation. There's a very important thing that you need to note here, is that before we even reach the formula, we have to check whether or not there's actually a nominal capital loss. In other words, was the amount, just in absolute terms, was the asset sold for lower or less than what it was originally purchased for? And the important thing to note there is that if, under this method, if there is actually a loss here, that we don't use the regular cost base with all of the elements in it. Instead, we use what's called the reduced cost base. So in other words, if when you're looking at this and you've got a problem involving a capital asset and you're trying to determine whether or not which of the form is going to use, you just have to look at the nominal value. Did this particular asset get sold at face value for less than what it was paid for? Because if it did, then we have to use a slightly different equation in order to determine what the actual loss for that asset is, and that's called the reduced cost base. In other situations, we use the normal cost base. The main difference between the reduced cost base and regular cost base is that one of the aspects, which is the non-capital cost of ownership, is removed from the reduced cost base. But we're not dealing with that in this particular problem. Here, we've got, at least nominally, a gain. We've purchased something in 1985 for $5,000 and sold it in this day and age for $8,000. And if we stop to think about that for a second, that's over 30 years. And you'd expect inflation to really reduce the purchasing power of money. In other words, that $5,000 in late 1985 is really going to be worth significantly more than what the same nominal amount, $5,000, is today. Now, there's a couple of other things to note here. That after you've determined the cost base, we have to find what's called the indexation factor. The indexation factor is found in Division 960. It's towards the back of the 97 Act. And these indexes, which are derived from the inflation rate at the time, you'd need to find the appropriate one from the quarter that the asset was purchased in. And on the other aspect of that, the other index that's divided from is going to be the index from the quarter of the 30th of September 1999. And there is just one little gotcha, one thing to note about this, and that's that once you've got those two index values, you get them and you divide one from the other, and then at that stage in the process, you need to round those to 3 decimal places. You don't do it later, you do it at that particular point in the calculations. And so here we're given the quite simple figures here, $8,000 that was the proceeds from sale, then cost $5,000, and we're given the two index values, 68.7 and 40.5. And that's a simple division. You just divide 68.7 by 40.5, or whichever the index is for that particular period, and then do the rounding at that step. So here we've got this factor, which is 1.696. It's important to note at this stage here that fundamentally there's no actual gain. In other words, once we've taken indexation into account, I guess what the calculation would say the fair value after inflation is taken into account would have been more than $8,000. But we've only disposed of $8,000 even decades and decades later. Sounds like a pretty terrible investment here, and as such, there's no liability for CGT under the indexation method in this particular and quite contrived scenario. However, what we would do is also look at the discount method. So the discount method here is much simpler. We just take the proceeds, subtract the cost base, and find the difference. And here that's simply $8,000 minus $5,000, which is just $3,000. And that's the amount of the gain before applying the appropriate discount. Now for the second asset, again this is quite straightforward. There's just a simple gain. So here the asset was acquired in 2002, so you're going to have you're not going to be able to use the indexation method. It's only going to be the discount method, and it's a simple calculation. Proceeds less the cost base, 3,000 minus 1,000, you've got a $2,000 gain. So the next step with CGT assets in terms of your net capital gain for a particular tax year is to add them all together, and once you've done that, you then try and determine whether or not you have any gain or loss, and it's that stage where you would go about including carry forward losses until doing that in that calculation. And so here the second asset we had is quite a simple $2,000 gain, whereas for the first asset we've got two potential capital gains here. Using the indexation method, it's going to be 0. Using the discount CGT method, it's going to be $1,500, and so really the logical thing to do, and the advice you'd give the taxpayer here, is to use the indexation method in relation to that first asset, and thus the $2,000 loss from the prior year can be used to offset the $2,000 gain that the taxpayer has for the second asset, and the result is simply going to be zero. There's no capital gain or loss for this particular year. And now the final part of this session is looking at what happens if an asset is sold sort of 6 months purchased and then sold within 6 months. Now, the CGT regime specifically addresses this, and it says, look, if an asset has not been held for more than a year, than for 12 months, then you can't get a discount. You still do all of the calculations, following all of the other steps. It's just that when you reach the end of it as an individual, normally you'd have this 50% discount. In that situation, you don't have any at all. And so in this scenario, we still have the $2,000 from the second asset, but if for that first asset, instead of it being purchased in 1995, if it was instead purchased 6 months ago, then we're going to have, first of all, we'll have a straightforward gain of $3,000. And when doing our calculations, that has to be quarantined and kept separately from the assets that, or the capital gains that we have that we can get the discount on. So here in this situation, the $2,000 from the second asset, we can apply the 50% discount, whereas the $3,000 in this modified scenario, we can't claim the discount. And so it's that component there that we would take away the $2,000 loss from the previous tax year, and the net result, as given by the equation there, is going to come out a liability of $2,000 at the end of this year.